Start. Hello, everyone. Hope you had a good coffee, and now we can start talking more about sustainability. Let me just start by saying my name is Mangal Goswami. I'm the Executive Director of the SEACEN Center. It's the Southeast Asia Central Banking Research and Training Center. I think this morning, Eddie, you mentioned that talent development is very important, and the earlier speaker also mentioned about how about training the regulators. So what the SEACEN Center does is exactly that, training. And in fact, I just came back from a capacity development in Singapore for the regulators. We have 19 central banks, including HKMA, PBOC, Reserve Bank of India, the ASEAN Central Bank under our, and in fact, EDU is one of the board of governors in our governance system. So let's get started. I just have a small confession to make. I came here on an Airbus 380 with a bit of an unsustainable model so far, but hopefully this is going to change in the future, and it was definitely not Cathay Pacific. But I think we have a long way to go in this journey. Hopefully next time I come, the fuel will be somewhat more sustainable, and the aircraft design will be a bit more amenable to such sustainability concerns. So let me just mention that climate risk is financial stability risk. And there is no doubt that regulators, central banks, other financial industry participants are all sort of looking at climate risk from the angle of clearly a risk to the financial stability, but at the same time that it also presents a lot of opportunities for the financial community. When it comes to financial stability, we really need to understand how this climate risk really transmits to the financial sector, be it through transition risk or be it through physical risk. We have to get a better understanding. Why do we need to do that? Well, the ultimate goal for everyone sitting here is that when we have an onset of this kind of a progression of climate risk and environment and so on and so forth, ultimately, if it poses risk to the financial sector, we want to have a financial sector that is indeed resilient to this kind of a green swanish risk, which is long horizon, uncertain, nonlinear, and very difficult to actually, and forward-looking, and very difficult to model. So we really need to have a good understanding so that we can devise a system that is much more resilient. And Mark Conry, who is a champion of this and is on the UN convoy, said it exactly right. He said that changes in climate policies will prompt reassessment of values of virtually every asset. And companies and funds that are not aligned to this are unlikely to exist for too long. So therefore, there is the mantra, and we need to sort of have a better understanding. So to have a better understanding of all of this, no one better than this elite panel, distinguished speakers we have here. So the first, let me just quickly introduce the speakers. Ms. Honor Retnesti is from Indonesia. She is the prudential regulator for OJK from Indonesia. Thank you for being here. We have Anthony Wong sitting there, and Anthony is the director of Intermediaries division from the SFC, Hong Kong. And we have also Grace to the other end, who is from the head of sustainability for Cathay Pacific. And of course, we have Taie Wang, who is the chief sustainability officer for Hang Seng Index. So let's get started. Let me just first pose the question to the panelists, to the discussants here, about how do we really integrate financial risk management into institutions that are regulated by, be it OJK or be it other regulatory institutions, because clearly, as was pointed out earlier, this is more of a policy initiative, and we need to make sure that we have the right regulation and the environment to move forward. So let me start with Ms. Honor. How is Indonesia sort of, as a prudential regulator, notably your role is more on the capital market side, how are you sort of setting the regulation to incorporate climate risk into financial risk management?
Okay. Thank you for the question. Good morning, everybody. Yes, and as we know that from the conceptual framework, we are in the risk-based supervision, we acknowledge the several inherent risks such as credit risk, operational risk, liquidity, and market risk, and other risks. Currently, risk-based supervision needs to translate the climate-related exposure into category of financial risk. As a prudential as well as market conduct regulator, you said that only prudential, but it's also the market conduct regulator. For capital market, OJK has recognized the financial institutions are exposed to physical in transition and liability risk. There is a set out in the Sustainable Finance Roadmap Phase 2, I think, yeah, in 221 and 225. In addition to the current-based supervision for capital market, we also see the need of climate-related risk assessment. So not only for the prudential aspect, also for the market conduct purpose. For instance, supervisory practice should also take into account the abrupt changes in market sentiment, greenwashing, and weather-related hazard in their assessment. This is important for us because we see many kinds of financial instruments that are labeled green or sustainable, but the regulator and supervisor need to ensure that the proceed of the financial instrument and their financial report genuinely reflect the way they benefit the nature and address the climate related risk. OJK is also looking at the use of SupTech and RegTech for a supervisory tool to financial sector, including in assessing and tackling the exposure of the capital market to the climate risk. The use of technology will increase the efficiency and accuracy of the information in financial industry reporting and simplify the supervisory process for regulator. Also, investor will get the benefit from this because they will easy access to environmental, social, and government information used in making investment decision. Another important factor in capacity building, considering this is the climate-related risk, financial risk is a new topic for Indonesia. So the fundamental to ensure the supervisor capacity to comprehend the topic. Therefore, the Sustainable Finance Roadmap Phase 2 was included the human resources component as a part of the ecosystem in the roadmap. To enhance capacity building, OJK seeks to foster collaboration with experts, research center, university, international institution, and forum to enrich the supervisor knowledge and understanding of the climate-related financial risk. Thank you.
Thank you, Ms. Horner. You did mention the use of technology, SupTech and RegTech, in assessing this kind of risk. So that's sort of really a frontier kind of an area where a lot of market participants as well as financial institutions are starting to embark on. So we can come back to that later as to how scenario analysis, stress tests can be further enhanced to such mechanisms. So let me just move to Anthony Wong. Anthony, how does SFC provide guidance in integrating climate risk to the fund management industry? If you could talk a little bit about assessing materiality and the impact of these risks on investment strategies and the likes.
So thank you, Mango, and thank you, Asifma, for inviting me. It's a pleasure to be on this panel. So just a bit of background in terms of the SFC regulatory approach. Well, we we introduced some amendments to the Fund Manager Code of Conduct in 2022 after an extensive consultation. And as previous panelists noted, the regulator also need training. And so we did a very extensive consultation, discussed with the fund management industry in terms of what they would expect in our first step towards incorporating climate risks in the requirements. And so as part of the mandatory requirements, we are requiring all fund managers to take into consideration climate-related risk in their investment approach and as well as their risk management. And so why we did that, I think from the feedback from the industry is that the extreme weathers and also a transition to a low carbon economy is going to be an immediate and significant impact on the value of investments. And so here are I just want to highlight some of the key requirements. What the objective of our amendments to the Fund Manager Code of Conduct is to ensure proper management of risks arising from climate change and also any transition risks as well. And so we also want to ensure that there is a clear disclosure to investors. And so if the fund manager is responsible for the overall operation of the fund, they also need to make sure that these climate-related risk management and investment approach is disclosed to the investors. While fund managers can adopt a broader E, S, and G in their consideration, it is acceptable as long as the climate risk is taken into consideration. And in particular, I think large fund managers, i.e. those with over 8 billion in Hong Kong dollars under their management, is required to disclose their engagement policy. In terms of engagement policy, it's about how they engage with companies to illustrate how they are coping with climate-related risks. And apart from that, they need to take reasonable steps in terms of identifying the carbon footprint of their portfolio to disclose Scope 1 and Scope 2 greenhouse gas emissions of their underlying investment in terms of enterprise value-based matrix. Other quantitative matrix can be disclosed as well in order to assist investors to have a better understanding of their investment approach. And large fund manager is also required to assess if scenario analysis is relevant, and also it will be helpful for them to evaluate the resilience of their investment strategies by taking into consideration the climate-related risks under different pathway. And so if it is relevant, and they are expected to develop a plan to implement scenario analysis. So from our perspective, we are looking to ensure that the fund managers' disclosure to investors on climate-related risks have a proper basis and are not misleading. And so in terms of assessing whether the climate risk is material, I think from our consultation process, a lot of respondents also sought clarification on that aspect. To that end, I think the Commission actually published some sample industry practices in our circular in 2021, August 2021, to illustrate what are the sample practices by industry participants. And from our perspective, I think flexibility is quite key because there are different asset classes, and different asset classes have different climate-related risks. And so we do want to afford flexibility to fund managers and to take a proportionate and appropriate approach in their when taking into consideration the climate-related risks in their investment and also risk management. So just some general ideas. They do need to adopt a process to identify whether climate risk is relevant and material. And in terms of materiality, of course, we provided some suggestions and some sample industry practices from the qualitative approach, i.e. that they, for example, they can assess the materiality map under the SASB standard, where they identify sustainability issues for different industries and rank them according to how likely they will have a material impact. And there's also quantitative approach, i.e. from the using in-house or third-party tools to analyze a portfolio's climate-related risks in terms of extreme weather changes, and also the assess the likely impact on the portfolio. So that's generally how we incorporate the materiality of climate risk for fund managers.
Just a quick follow-up, Anthony.
Yeah.
I mean, is there sort of these are not guidelines, these are clearly mandates that the reporting is mandatory and above a certain threshold. Could you just give us a flavor of that?
Yeah.
What is
it is mandatory for all fund managers to take into consideration climate risk in their risk management and also their investment approach. And the disclosure is needed if they are responsible for overall operation of the fund. They need to make such disclosure to the investors. And from our perspective, and these are not disclosure to the commission. These are not disclosure to the SFC. These are disclosure to investors. And from our perspective, we will look at the quality of the disclosure and also whether such disclosure have a proper basis, I think.
Excellent. Thank you, Anthony. That's really fantastic. Let me move to Grace. Grace, a listed company. So give us your perspective, how does an airline company like Cathay Pacific embed this kind of financial risk management into its DNA?
Thank you, Dr. Mangal, and thank you for having me here today, sharing with you the experience at Cathay. I think climate change definitely is a very material topic for airline industry and a material risk as well. And how we approach it is really, I think the keyword is embedding. Embedding the climate risk management not independently, but as part of the overall enterprise risk management approach, which we adopt, which lead by our Chief Risk Officer. We have a very robust enterprise risk management system. So through that regular exercise, climate risk is identified as one of the top 20 risks for Cathay Group as a whole. So going through the process, we regularly evaluate the climate risk in terms of potential and the level of impact in terms of finance, operation, regulatory, legal, and also health and safety. So sort of like all-round potential impact to our operation. And also going through the process, we also look at our existing controls and also what new initiatives we may need to bring into to mitigate and manage those risks. So this result is evaluated at least annually to make sure we are on top of whatever impact climate risk may bring to us. And I think it also resonates some of the points that William mentioned earlier. We specifically on climate risk, we also go through the exercise of scenario planning, really based on potential pathway of how humankind as a whole approaching climate risk, whether we all successfully transition to a low carbon future, or whether business largely remain as usual. What under this very different scenario, an airline Cathay Pacific, with our existing climate change strategy, how strongly our strategy holds under this very different scenario. The low carbon scenario would absolutely put more pressure on transition risk especially in terms of investment required. But if the business stay as usual, there could potentially much higher impact on physical risk in terms of affecting operation and all that. So I think it's really about embedding the whole process in the ongoing risk management approach for the company. And that would really show how strong a company takes that climate risk management into its overall key business decision.
Thank you, Grace. Thank you very much. So indeed, for transition risk, which is one of the most important things for a company like Cathay Pacific, An important ingredient into this is the pricing of carbon, because that's how the transition actually will advance in future. And the pricing of carbon clearly is done in various different ways. Europe has a different caps and trade system, whereas carbon taxes. But that's not the topic here, but that is going to determine, that policy is going to determine the trajectory of transition for all our companies in Asia. So that's a... By the way, I just wanted to mention that both Grace and Anthony have alliance to Malaysia. The SEACEN Center is in Kuala Lumpur. She likes durian, she comes there. And Anthony has some, you know. And also we have Assistant Governor Nurhana, who is here from Bank Negara, Malaysia. So we have Malaysia presence here, so, which is good. Let me move on to the next panel speaker here is Miss Taie. Okay, I would say Miss Wang, but Taie. Okay. Thank you very much. And if you can sort of tell us, you know, from a company that is an index provider and this whole panoply of ESG investment that is taking off, hopefully, you know, how do you sort of craft your indices? How does it work, you know, to inform investors that this is indeed an index that caters to this kind of the investment class, and how do you sort of do this?
Sure. Thank you, Dr. Bando, and thank you, Asifma, for the invitation. So I'm Taie. I work for the Hang Seng Indexes company. So I look after the sustainable and emerging business. So at Hang Seng Indexes company, we do have a very long ESG journey, starting as early as 2010. So over the years, we offer a variety of ESG and low carbon related indexes with you know, covering different strategies, including ESG integration, thematic indexes, as well as decarbonization focused indexes. So we do believe that indexes play a very important role in helping investors to mitigate climate risk. Climate risk, we all know that it comes from the climate change caused by human activity. So the primary cause of climate change is due to the greenhouse gas emission of fossil fuels, including you know, thermal coal, oil and gas, etc. They contribute to over 75% of the world's whole greenhouse gas emission. So to mitigate climate risk, it's very important to lower carbon emission in investors' investment portfolio. So as an index company, there are different ways to construct indexes in order to help investors achieve that goal. For example, when we construct the indexes, we can exclude companies that are high emitters or companies that are deemed as posing very significant threat to the environment. We can also reweight the constituents by overweighting the lower emitter companies and underweight the high emitters in order to achieve carbon reduction. So recently we launched a Hang Seng Stock Connect China A Low Carbon Index, which selects from the 300 largest companies in China A market, which are Stock Connect northbound eligible. So this provides a very easy access for international investors to get into China market while at the same time lowering the portfolio carbon footprint. So we exclude companies that are involved in thermal coal, power generation or tobacco products, etc. And we also overweight the lower emissions, etc. So it results in a very significant carbon reduction in the index with around 45% of carbon reduction compared with the underlying benchmark, while at the same time, this index keeps a very close tracking to the underlying benchmark. So we believe that this index provides a very good channel for investors who would like to invest into China, because China is such a huge market that you probably don't want to miss out. but at the same time, China as the biggest emitter in the world, there are certain high emitter sectors or companies in China. So by investing in this low carbon index, it can help investors reduce the carbon footprint. At the same time, get a very tight tracking to the largest companies in China. So this is one way how we do it. So speaking of climate risk, transition risk is also a very important part. So our indexes can provide a very good way for investors to manage the financial risks, especially to capture the opportunities arising from transitioning to a lower carbon economy or greener economy. We offer a variety of green economy or low carbon themed indexes. So those indexes select companies that are in the area of, for example, renewable energy or clean energy or electric vehicles, etc. So those sectors are expected to benefit hugely from the government policy initiatives in order to meet the net zero goals. Recently, we launched Hang Seng Stock Connect Hydrogen Energy Index, because energy is hydrogen energy is very versatile, and it plays a very important role in helping decarbonization, especially in the hard-to-abate sectors, for example, the long-haul transportation or the steel and the iron industry. This index selects the top 30 companies which we believe are most relevant to the hydrogen business. So we hope that this index could offer the investors a very good channel to get into the hydrogen business, while at the same time mitigate the idiosyncratic risk associated with investing in a single company. So yeah, hopefully we can
Thank you, Taie. Actually, the clock is ticking faster than my heartbeat, but we'll try to manage that risk. But just before I come back to Ms. Ona, because Indonesia is the big, investors are eyeing Indonesia in a big way, how it transitions. But talking about transition versus green, if we were in Europe, the ESG indices are quite straightforward because they only talk about green versus the rest, dirty. Whereas in Asia, as we heard today, it's all about transition. This is where transition. So very quickly, if you can tell us, if I am a company which has a very good transition plan, do I qualify for how do you assess, what kind of an index? Do you have different suites of indices for people which is a green company versus a transition company? How does that work?
Yeah, I think in the area of ESG or low carbon area, there's no one size fits all, because each investors are different. They have their own unique situation. They have their own low carbon or climate risk management objectives and targets, and they have their own investment performance targets, as well as risk tolerance. For example, how much they can tolerate the tracking error or risk appetite, etc. So there's no one size fits all. So we have to offer a full spectrum of variety of indexes to meet the demand or requirement of different investors. Some investors, they want to take a more aggressive carbon reduction goal, while other investors maybe want to take smaller steps. Some want to take a divestment approach. Others prefer engagement. So we will try to offer all various different strategies. At the same time, we try to work with investors closely to offer a tailor-made solutions to meet their own specific needs. So yeah, there are many different criteria when we construct the indexes.
Yes.
So.
Yeah. Thank you for giving us that explanation. Let me just move to this. I don't think we'll have enough time to engage everyone in this discussion on we talked about disclosure and supervision, sort of, now you've incorporated climate risk, but how do you actually, convince, as was said this morning, how do you see eye to eye and say that, okay, I'm a company that is indeed doing something along the lines of sustainability. So, TCFD has been a great guiding light in this, and ISSB is the International Sustainability Standards Board will sort of take it to the next level. But how is Indonesia doing this from your perspective of disclosure, be it on the governance side, be it on the risk management side, be it on the data metrics side? How is it actually, and the strategy side, how are you sort of crafting this for Indonesian firms and fund managers?
Okay, thank you. Yes, I agree with the disclosure aspect. Through reporting is an important thing, especially to enable the supervisor to see the financial report, institution responsibility, and their impact on ESG. In Indonesia, we have already several OJK regulation regarding the reporting, mandatory of reporting for the issuer and the public company. And then that's reporting is that regulation have recognized and adopted several international reporting standard, including the Global Reporting Initiative, GRI, the Task Force on Climate-Related Financial Disclosure, TCFD, and the Sustainability According Standard Board, SEACEN. We have also the OJK regulation regarding the mandatory reporting for action plan of the sustainable finance for securities company. That's the last reporting should be on January next year. Yeah. Also, we support climate-related finance. OJK also issue Indonesian Green Taxonomy to identify the greenest level across industry sector, including mining and palm oil plantation sector. As one of the effort to prevent greenwashing in reporting by financial service sector, the Green Taxonomy is formulated as a guideline for financial service sector in allocating their financing, as well as their green portfolio record keeping. Forward, Green Taxonomy is also envisioned to enhance the quality of disclosure in financial stability report. Also in Indonesia, this year, we have already stipulated and enacted the Omnibus Law regarding...
This is what I was going to ask you about. The
oh, okay.
This is very, yeah.
Yes, this is one in the most important, that the Omnibus Law has defined carbon unit as a securities and required the trading of the secondary instrument of the carbon economic value in the carbon exchange. The carbon exchange is to be established by the Securities Exchange that has obtained a business license from OJK. To follow up the provision of carbon market in the Omnibus Law, OJK is preparing an OJK regulation draft on the carbon market operator and stimulously establishing the trading infrastructure in the carbon exchange together with the self-regulatory organization. However, before this, in the 2017, we also have already applied the regulation, have a regulation related to carbon bond, green bond. That will be we will make including to the larger provision is in the, not only the green bond, it's also the other sustainable bond and other bond. Yeah. Thank you.
Thank you. That sounds like, as I mentioned, Indonesia is going to be one of the countries that will be most watched in this era, given that the country's potential and the decarbonization challenges going forward. But capital market instruments are already being issued under with OJK's new framework and with the green taxonomy being adopted. And where are we on the transition taxonomy? Is there some sense of that is coming next? How do you see that panning out in Indonesia?
Yes, we are now is in the plan to go to the sustainable and the carbon market. We have already the task force that include the all institution and the ministry in Indonesia. Then we are serious to doing that. In this, maybe in the next 6 months, we will have the carbon market. Yeah, we hope so. We hope in this year we will get the carbon market, and the stock exchange also prepare for that. Yeah. Thank you.
Thank you very much. I think we are running very close to, we may be penalized for going over time, but Anthony and the rest, I think Taie and Ms. Cheung, Grace, could you just take like 45 seconds or something to give us your take on this disclosure, what you're doing, very quick. My apologies for this quick one.
Okay, 45-second challenge. So Cathay Pacific really support of standard disclosure metrics. We believe it helps us to know how we measure up to our competition, and I think it helps all of you here to understand what other airlines, different airlines, how well they perform on climate change. So we have been pushing that as well in the industry group that we sit on in the IATA International Air Transport Group that work on this standard there. So I think just some tips to share, I think for whoever here may look in airline performance in climate change, I would suggest like maybe 3 kind of like factors to compare how an airline do in climate, their climate effort. The first is the percentage share of like how much investment they put in renewing their fleet. I shared with William earlier that each new generation of aircraft actually could perform 20% fuel efficiency improvement, meaning carrying the same number of passengers over the same distance, but using 20% less fuel. So when you look at the airlines of like portfolio and see their fleet plan, you can kind of like tell an honest picture of how much they invest in really decarbonizing. The second factor is really reflected by their fleet plan plus other efforts is their efficiency in terms of productivity. So it could be measured in terms of gram CO2 emissions per their capacity in terms of sort of like available tons kilometer or in terms of revenue tons kilometer, basically how well they put their asset into usage, so reducing the average emissions while serving the community. I think the last part is really the key lever we as commercial airline really see to help the aviation industry decarbonize before the 2050 commitment of net zero is with the use of sustainable aviation fuel. So while hydrogen is a good topic and electric plane may sound very sexy, for like a place like Hong Kong, when you need a lot of intercontinental long-haul travel, the only solution you can get in the next 30 years is really the use of sustainable aviation fuel. So my last pitch, we do need the financial industry to channel the type of investment needed in the billions of dollars required to really invest into sustainable aviation fuel industry. Otherwise, the whole aviation industry will not have enough of this renewable fuel to continue to fly you everywhere you need to go to develop your business in a sustainable way. Thank you.
We have hit the net zero there, but just very quickly, Anthony and Taie, just if you can.
Sure. I'll just quickly talk about how do we ensure compliance with the code of conduct. Just a few points. We look at, it's just a simple, we conduct on-site inspections, and so as part of our review of fund managers, we will ask these questions, whether they think climate-related risk is relevant. If it's irrelevant, do they have a process to reevaluate it? If it's relevant, is it material? If it's not material, do you have a way of reevaluate whether the materiality of the climate risk has changed? And then there's a governance issue, i.e. is there a tone from the top on climate-related risks in the fund management? And also, finally, it's about disclosure to investors. We will, if they say that the most important objective of the fund is to invest in improving the biodiversity, for example, are they doing what they claim to do? And so that the consistency and the basis of the disclosure to investors is very important. So that's how we assess the compliance with the code that we have just amended.
I'm getting very strict guidance that we need to end here, but Taie, just quick one. Very sorry, Taie. My apologies.
Yeah, so disclosure is really important, especially for index companies, because without the disclosure, there's no data for us to construct the indexes. So good thing is we have seen that regulators are increasingly enhancing the disclosure requirement, so this is a good trend. And Anthony also mentioned that there's disclosure requirement for fund managers, right, on the fund level. So as an index company, we do try to be as transparent as possible. So we publish our index methodology in our website, and we also offer periodic, publish the factor sheet about our indexes to show the performance, including returns, risks, profile, as well as the performance at ESG or low carbon related matrix. So investors can really see whether our index is doing what we are supposed to do. So yeah, hopefully all stakeholders, including corporates, regulators, as well as us index companies, can work all together to drive the agenda forward.
Thank you very much. The soul searching continues. So a big hand to our panelists. Thank you very much. And all the best. Thank you.